Hello, friends. Welcome to the much anticipated next installment of the Financial Planning Vicennial, Planning at Age 59. I wrote the Financial Planning Vicennial for age 58 in late November from home as we were still under lockdown. As is par for us, so much has changed since then. We are back at the office full time and are pleased to welcome Paul Corbier, a realtor with the Real Estate Center, into our suite. Paul runs a completely separate business from us, but he is an excellent personality match and is nice to visit with in the social areas of our office. I've also been busy getting my fingers deeper in the financial industry. Let's see if my page down works today. Hey, there we go. Okay. No, I need to stay on this one. Okay, by the time this is published, I will have written and hopefully passed 2 more trust and estate practitioner designating exams, the 4th and final in November. I have been named as the chair of education for the Institute of Advanced Financial Planners. I've become a life and qualifying member of MDRT, which means I have now qualified for 10 years consecutively. And the more fun thing, Darcy and I were flown to Washington, D.C. because I represent Canada as a global council member for MDRT. Just move myself aside. So I'm that guy. So that was really nice. That was fun. That should pretty much catch you up. Busy as always and loving it. So, as the leaves rustle in the trees outside my window, let's segue into financial planning for age 59. Age 59 is a gateway year between one's peak earning years and achieving financial independence. Most of Western society still accepts age 65 as a key retirement date, so the next 5 years will bustle with pre-retirement activity. Age 59 is the year that mostly determines what those activities are. It is the year of the plan update, the fiscal fast, and the first glimpse at practical estate planning. The plan update. Most people only retire once. Advisors, however, have the great pleasure of helping other people retire through most of their career. So through this experience, we come to know that compared to accumulating your nest egg, decumulating is way harder. It takes a much deeper of an understanding of taxes, investments, and most of all, people. More than half of adults age 59 fear running out of money in retirement. And according to a recent study, 44% even consider themselves anxious about it. And that's completely fair. Regardless of how much somebody saves and pre-plans, leaving employment means giving the ability to earn an income. Giving up. This is supposed to say giving up. It means giving up your ability to earn an income. And the last thing we want to do is placate this fear. If you are 59 years old and contemplating leaving your career, you have earned the right to feel anxious. So instead of, stay on this page for a minute. Instead, we can lean towards these concerns and embrace them by understanding the math around them and by building structures that support them. One of the things that we learn at MDRT is that if you are balanced, you're not moving anywhere. At the time of this presentation, the speaker was riding a very tall unicycle, but he said that in order to get somewhere, you have to unbalance. You have to lean into the direction that you want to go. The action item here is that an age 59 financial plan update will need a concentrated and focused lean towards cash flow planning. The more detailed, the better. So there are 2 main questions that we demand of the age 59 financial plan update. One is, how much can you afford to spend? And the other is, how much can you afford to live on? If your accumulation journey has gone well thus far, then these are completely separate things. Age 59, Action step 1, gather all of your pension updates and investment statements and send them to your financial planner. They can help you get the answer to the first question: how much can you afford to spend? We do family mantras at home, although we don't necessarily call them that. Here is one to end this section. You can have anything you want, but you cannot have everything you want. Next part, fiscal fast. The next question to answer is, how much can you live on? Enter the fiscal fast. When we talk about a fast, you're maybe thinking about when you had to get blood work done last and were forced to self-restrain from food and water. And while necessary, there was a deprived unhappiness to it. Taken another way, fast can mean accelerated movement. Our kids would call it launch mode. Launch mode. When we are in our accumulation years, we are often running so fast that we self-restrain from beautiful moments. And that also kind of has a deprived unhappiness to it. The fiscal fast is about choosing to self-restrain from all of the fastness of working and earning and saving and spending, and learning who you are when you slow down. To figure out the answer on how much can you live on, we need to enter a fiscal fast. And the key word here is live. We're not asking how much can you survive on. I want to know how much it takes for you to live. There are 2 ways that you get to find out who you truly are in any area of life. The first one is in a moment of crisis, and the second is in a time of prolonged boredom. The fiscal fast is that time of boredom. It should ideally be no less than 3 months. And in this fast, you are trying to do your best not to buy any distractions. Allow yourself the gift of boredom. If you end up spending your fiscal fast in distraction, then you might be ready for financial independence, but you are not ready to retire. So consider this second mantra. If you don't do it now, you won't do it then. If you think you want to golf in retirement, but now you find yourself on the couch instead of mowing the lawn or studying the topography of your yard, then you probably won't be golfing in retirement. If you think you'll be painting in retirement, but your art supplies are downstairs and downstairs is cold and it doesn't have the right lighting, so instead you're touring the kitchen cupboards once again in search of nacho-like treats, then you probably won't be painting in retirement. The fiscal fast is your opportunity to choose your do-it-nows so that you will have some do-it-thens. And our second action step for our age 59 financial plan is to enter a fiscal fast. Give yourself the gift of boredom. After 3 months, bring in your bank statements and credit card statements from your fast to your financial planner. And now we can answer the question, how much can you live on? The answers to these 2 questions will help give context to the fear of running out of money, and it allows you to prioritize your actions that need to be taken in the coming years. All right, good. Third section, practical estate planning, a first glimpse. One of the more common side effects of investors raised by parents who had lived through the Great Depression is this habit of hoarding money. This materializes into a whole bunch of cluttery little accounts at different financial institutions, but it also materializes into having a hard time conceptualizing an estate that is big enough to be worthy of planning. For the mass affluent investor whom we most typically work with, this looks like an accelerating net worth into the early 70s, plateauing into the mid 70s, cresting into the 80s, and then some general level of actually spending down your net worth after that. Estate planning has many different facets, but one of the items that might be particularly interesting to a 59-year-old is that they can still flaunt their insurability most often. And so we want to look at planned giving. Canada doesn't have estate taxes, and Alberta estate administration fees, more commonly known as probate, are nominal, but there is potentially sizable capital gains and from non-registered investment, rental properties, taxes from selling farmland or a business that are over the lifetime exemption, and taxes from the deregistration of a RIF account or a matured RRSP. So I'm going to put some numbers to this illustration just to make things a little bit easier. It's just a first glimpse, but for the sake of that glimpse, let's say we have a couple of 59-year-olds, and they will have $100,000 of taxes and probate fees, etc., owing on their terminal return at the death of the second spouse. If no estate planning is done, this tax comes out of the estate, a clearance certificate is obtained, and the residue of the estate is allocated as per the instructions in the will. As an alternative to paying the taxes outright, the conscientious 59-year-olds purchase a joint last to die insurance policy for $200,000 with a named beneficiary as a local registered charity. A whole bunch of assumptions later, and that $200,000 life insurance policy costs $105,000 over the life of the policy to fund and creates a $100,000 charitable contribution receipt. Or, well, like the receipt's $200,000, but a charitable tax credit. With some extra planning, we have successfully disinherited the CRA to the favor of a life insurance company, and in the meantime, a charity has received a significant donation that the estate would otherwise not have been able to afford. Why is this a focus for our age 59 plan? The answer is that after age 59, the cash out of pocket required to fund the insurance policy starts to become more than what the tax bill would otherwise have been, and that makes it less fun. The charts below, we are looking, or here, kind of to the top, show actual numbers from a BMO term to 100 policy on a male-female couple. Both are non-smoking and of average health. So you can see the orange line here is reflected with the orange legend. That's the monthly cost of insurance. That's not the more interesting part. The more interesting part is the blue line, which is that monthly cost of insurance times 12 for a calendar year to age 95. To age 75? Oh, age that the policy is purchased. Yeah. So we're planning for to age 95 before the death benefit payout. You wouldn't buy a policy after age 75. Potentially, you'd have a hard time getting one. But the red line is that $100,000 of taxes. And so age 59 is right as that blue line starts to diverge from the actual amount of taxes owing, so that it costs more to actually put the strategy in place. It's super fun when you get to choose CRA or life insurance company with a bonus to a charitable organization. That's why it says below. Okay, so age 59 action step. This is action step number 3. Once you have figured out how much you can spend in retirement and how much it costs for you to live, your final step is to consider how much will it cost for you to die. Our mantra for this section. We used this one maybe 2 weeks ago for James. Inner peace doesn't come from having everything you want. It comes from wanting everything you have. So if you don't want everything you have because you have more than what you want, you can give what you have a purpose with abundance through planned giving and make it the part of your legacy that you want the most. And a disclaimer, I will move my face out of the way for the purposes of making that more readable, and Alberta specifically being highlighted because I skipped over probate as it's nominal. However, note that pretty much everywhere else, with the exception of Quebec, probate planning is a real thing and should be considered as any estate planning strategy. Okay, thanks so much, guys. Take care. Many happinesses. Talk soon.